Hi, all. Craig Cook with Acre Mortgage here, and welcome to my channel where we talk about mortgage topics like loan programs, any helpful information to home buyers or real estate professionals is where you're going to find on my YouTube channel some helpful information about that topic. So, needless to say, today's video is about the 203K loan. It's an awesome product, and it's a renovation loan. And it is one of the only products that allows you to purchase a home and finance the renovations all with one loan product. So let's get right into it. My name is Craig Cook, and I've worked in the mortgage business for almost 20 years now with Acre Mortgage. I've helped plenty of home buyers with this particular program, and I know that it's helped a lot of people by certain types of properties, maybe foreclosures or houses that need a little bit of work, and you just don't have the money to finance the or to pay for out of pocket the things that you want to do to upgrade your house. Whether it's putting in a new bathroom or bigger projects, this loan product is perfect for that. And my goal is to show you how powerful this loan tool can be. So what is a 203K loan? It's a type of mortgage, like we said, that allows you to finance the purchase of your home as well as the cost of repairs and renovations. It's a loan backed by FHA and insured by HUD. So what that means is that the loan guidelines follow FHA rules. So if typically, in most cases, if you qualify for an FHA loan, you most likely will qualify for a 203K loan, which is good because FHA has relaxed guidelines with credit and income. And let's talk about what types of 203K loans there are. So you have a standard 203K, which is for larger projects. Maybe if you're adding an addition, anything that's structural in nature or requires extensive repairs. A limited, better known as the streamlined 203K, is for smaller projects. Maybe it's just minor cosmetic stuff. Maybe it's plumbing issues or even the installation of a septic tank, because that's common in our area that some of the rules and townships have changed and you might need a new septic tank. This can all fall under the umbrella of a limited 203K project, except with the limited, you're only able to have a budget up to $35,000. And that's total rehab costs, and we'll get into how you figure out total rehab costs in the future slide. So what are the benefits of the 203K loan? So the ability to finance both purchase and rehab costs, purchase of the home and rehab cost is obviously a really big benefit. So roll all the cost in the one mortgage payment, amortize over a longer period of time. Like typical home, I guess, second mortgages, like home renovation products or home home improvement loans. That's the word I was looking for. That you would take out maybe after you close on a house, or credit cards. These all have higher interest rates, and they typically have lower amortization periods, which means you have to pay it off sooner. Like it might be a 10-year loan or a 5-year loan, whereas with FHA products, you can go up to 30 years. So the longer you can amortize a product, the longer period of time that it takes for you to pay off that debt, the less your monthly payment. Allows you to purchase fixer-uppers that won't qualify for traditional loans, right? You see this a lot with people trying to get traditional financing on foreclosures or as-is properties that might need a little work, that maybe a standard FHA loan or standard conventional loan won't allow you to buy, because that lender or that loan, I should say, has guidelines that not only do you have to qualify for or be eligible for, but the property also has to be eligible as well. So this allows you to buy the house in its current condition with repairs being needed, and then as long as you're financing the repairs that brings that property up to a qualified status, you're able to purchase that house and have those items repaired after closing. Um, Flexibility in terms of property condition and types of repairs allowed. So, structural repairs, right? Adding a new kitchen, knocking down walls, adding an addition. You can even fix an existing swimming pool. Unfortunately, you're not able to put a new one in with an FHA loan because it's considered like a luxury item. You can finance energy efficient upgrades like appliances, maybe a stove or a refrigerator that's energy efficient. Cosmetic upgrades, new flooring, cabinets, painting, you name it, you could probably do it with this type of loan. There's certain things that that are specific for each lender, so make sure you talk to your lender of what they're allowing in terms of items that they'll allow to be included in the rehab project. Another big benefit is potential for increased property value, right? As let's just say you're buying a property that needs a lot of work, its current value might be a lot less than what it would be if it was better quality, right? Better condition, brand new kitchen, maybe paint, or adding an addition, an extra bedroom, an extra half bathroom. That builds equity, right? Because your house is now in better condition once it's done, and it compares to other properties that are similar that might be selling for more money if you add certain amenities or certain upgrades. So technically, when you're doing this loan, you're adding potential equity to your property. The adding of equity gives you better positioning when refinancing your house, right? So maybe you took out a loan that's very high in comparison to what the value of the house was when you bought it, right? But then as you build equity in this home and you've upgraded this home and you're building equity, now later down the line, you might have a better equity position, right? And better equity position gives you better terms for another loan, right? So if you're refinancing, maybe now you have 20% equity, whereas with the FHA loan, maximum financing, you have to have mortgage insurance. Maybe later down the line, you have enough equity in a quicker period of time to not need mortgage insurance and maybe do a conventional loan. So that increased equity gives you better positioning when refinancing or looking at a new loan. Increased equity means better profits when selling your house. Even if you were to buy this house, live in it for a period of time, and then sell it, right? Now it's in better condition, might be better condition than other properties because it has brand new upgrades. So more equity means more profit in your pocket if you go to sell the property. Eligibility, property types. You could borrow for single family residences or multifamily 2 to 4 units. So anywhere from 1 to 4 unit property. It has to be residential. FHA does allow some mixed use, right? Zoning with properties, but you got to be careful. Talk to your lender, make sure that's something that's allowable with this type of loan. But the good thing is that FHA allows maximum financing on 2 to 4 unit properties up to 96.5% of the total acquisition cost. So that's super important because if you're going to live in one of those units, you have to occupy it as a primary residence. One of those units you have to occupy as a primary residence, I should say. But no other loan type allows for that high of a percentage of financing with a renovation component, which is awesome. You must meet a minimum credit score of 620. Although FHA allows for lower credit scores, most lenders won't do this type of loan because there's more risk involved under a 620. Just depends on your lender. Talk to your lender about their credit score requirements for this program. The debt to income ratio. Typically, FHA wants you around 31% of your gross earnings being spent towards a housing payment, no more than that spent towards a housing payment, and 43% roughly being spent towards the total debt listed, total obligations on your credit report and the mortgage payment. So your total debt load monthly cannot exceed 43% of your gross earnings monthly. But FHA ratios are determined by an automated underwriting system, so you can go higher than that normally. And in my experience in going through that automated underwriting system, the line drawn in the sand is about 56.9% total debt ratio and 46.9% housing payment ratio. If you want more details, you can always talk to your lender about, general FHA qualifying guidelines. So all you have to do is meet all the other criteria for FHA loan, and you can technically qualify for a renovation loan. Contractor eligibility is important. They must be licensed and insured and complete a profile resume, meaning they have to have done some type of project before and have people that they've worked with that will basically vouch for them. And this is important, and it might not be required for all lenders, but most lenders that I know that offer this product require a resume to be completed. Unfortunately, although FHA allows for self-help, if you're like a contractor that can do your own work and you're licensed and insured and you want to save money, a good percentage of lenders won't allow you to do the work yourself because there's a conflict of interest there. But make sure and check with your lender if they allow self-help. So what are the differences between these two types of renovation loans, the standard and limited? So the standard allows for structural and non-structural repairs in nature, like we said, addition, larger projects, want to knock down walls, anything that's structural, right? If you're, even if you're changing joists or, knocking down sheetrock, that can be considered structural. So you want to be careful. Even if the repairs are less than $35,000 in total, you could have to do a standard FHA 203K loan versus the limited. The limited is non-structural only, cosmetic in nature, minimal upgrades. And regarding the rehab in section number 2, we're talking about standard. You have to have a minimum of $5,000 in repairs, and you can go up to the FHA loan limits. The FHA loan limits are different, and they're based on the county, and we'll talk about that, county and state, and we'll talk about that in another slide. There's no minimum repairs for the streamlined or limited version of the 203K, and your max total rehab costs cannot exceed $35,000. The standard, a HUD consultant is required. A HUD consultant is like a project manager that works to manage the work that needs to be done between the general contractor and yourself, right? And they're there as like a safety valve to protect you from overspending on certain phases or work that needs to be done for a project, right? If a contractor is saying, hey, you need to spend $30,000 to put in a new bathroom, the consultant might say, that type of work should only cost you this. And this way you could take a report from a consultant and go find another contractor that would accept that bid. So basically it's a safety mechanism, right? Having that consultant there, it helps in keeping the project in line, and that you're not overspending for certain things during renovations or during a project. For a limited, you don't need a consultant. You only need a licensed general contractor, and it just has to be listed. The work that's being done has to be listed on an estimate, has to be done in a certain way. So make sure you talk to your lender about how they want your contractor estimate worked up. It normally has to be broken down in terms of labor and materials. For standard, draws at closing are limited to 5 maximum draws. So the work has to be separated at most into 5 draws. It can be less than that, and at worst, it would be 5 draws. Or I should say, in terms of what you're able to take out at closing, because this is what this section is referring to, is what can you get at closing as an initial draw. An initial draw at closing for the standard would be limited to, I believe, a percentage of the materials for that have already been paid for. So each lender is different. You want to talk to them about that. But you're going to be limited in terms of what you're able to take out at the initial draw at settlement um, for the standard 203K loan. For the streamlined or limited version of this product, you're able to take up to 50% of the labor and material. So that's big, right? If the project is small, you can get a check cut at closing for 50% of the labor and material. So that's a pretty cool thing. For the standard 203K loan, you can finance up to 6 months of principal, interest, taxes, and insurance if the home is not habitable. Let's say you're doing a big project, you're still going to have to make that mortgage payment. So the flexibility of doing a bigger project, they know that you're not able to live there, and you have to obviously find different shelter while your house is being worked on. You can finance up to 6 months of that mortgage payment and the renovation costs, which is super good for people that are looking to do larger projects and they're worried about having to pay that mortgage payment right away. The limited, you have to move in within 30 days. It's got to be habitable because it's mostly cosmetic stuff. I feel like they're a little bit flexible on that 30-day, the 30-day time frame. So, but you have to move into it in a pretty short time frame. Loan limits and funding. Like I said in the previous slide, the loan limits are based on county and state. So the higher the units, meaning the closer you get to 4 units, the higher the max loan amount. For example, a 1-unit property in Burlington County, New Jersey is $529,000. A 2-unit property in Burlington County, New Jersey is $677,200. So you can't exceed whatever your county and the associated unit type would allow. Funding of renovation costs. In certain cases, there will be initial draws at settlement, like we talked about in the previous slide, the differences between the standard and the limited. The remaining renovation funds will be held in escrow. So whatever is left over to fund the project, whatever's left to do in the phases that would be dedicated to finish the work, that'll be held in escrow by a servicing lender, and then the checks would be cut after the phase of work is done. The loan will be sold to a servicing lender, and then you'll be introduced to that servicing lender with usually a letter, and that's when you know that it's safe to kind of move on and keep doing work. Disbursements for a project will be based on draw phases, right? So if there's 5 draw phases, and let's say in the first phase of work and it's a larger project, they're going to rip up all the floors. They're going to knock down all the walls and then put up new sheetrock. If that's all being done in the first phase, that phase of work has to be completed. And then an inspection takes place by the HUD consultant. If it's a smaller project like a limited, it'd be done by the appraiser. And then once they confirm that work has been completed, you'll be issued a check to reimburse yourself for that first phase of work. And inspection is completed, then checks are cut for the previous phase. So we talked about those last 3 bullet points and how that works, how the checks are cut based on the previous phase of work being done. Determining the loan amount. So this is important to understand so you can know, right, how a lender is going to qualify you and how much money you might need in general. So the purchase price plus the hard cost plus the soft cost equals your total acquisition cost, right? So just to give you an idea of what hard costs are, that's the estimate of work from your contractor, right? So you have your labor and materials. The soft costs are all the costs associated with the renovation financing itself. And we'll talk about some detailed soft costs in the next slides. So that gives you your total acquisition cost. So your total acquisition cost multiplied by the maximum financing loan to value, which is 96.5%, gives you your max loan amount. Your minimum investment is 3.5% of the total acquisition cost. You also have another formula, which is the after improved value times 110% multiplied by 96.5%. That gives you also a certain number, and your investment would be 3.5% of that number. Whichever formula generates the lowest number is going to be your max loan amount. This is good for some reasons too, because sometimes you might be buying a property that is, let's just say, $100,000, and you need to do $30,000 worth of work. And maybe the $30,000 worth of work that you want to have done isn't going to equate dollar for dollar improvement in value, right? Maybe it's going to be 110,000 after you put in new paint or add new appliances. The good thing is that 110%, right? Gives you that wiggle room, right, of going up to 110% of the after improved value. Gives you that wiggle room if for some reason your house isn't going to be valued higher than the total acquisition cost, if that makes sense. And we could talk more about that in detail if you decide to talk to me about doing this type of loan. Hard costs and soft costs. I don't know why my slides are looking like this, but I am going to try to get through this anyway. Hard costs, labor and materials for completion of the rehabilitation. It's listed on the contractor's estimate. If the HUD consultant is needed, then it's going to be listed on their write-up. And like we said before, a HUD consultant is there to kind of manage the project. They're going to do a work write-up and say, this is the maximum amount that you need for this section of work to be done. They're going to break down the draw phases. But remember, it's only needed for larger projects for that standard 203K loan. What are the soft costs? And that's all the costs associated with the renovation financing. Contingency reserve. That is a buffer fee, right? And it's 10 to 20% of your labor and materials, and it's set aside to protect you and the contractor in case you've underestimated for certain parts of the job, or more money is needed at a certain point in time and you've miscalculated in some way, right? The last thing you want to have happen is if you take out this loan and you don't have some type of emergency fund and you thought that the project was going to cost you this and it ends up costing you more money. With that contingency reserve, let's say you were looking to, get some plywood, right? And the cost of plywood, according to the contractor's estimate, was a certain number. And that number is a little bit higher. Well, if you needed to, you could always go to that reserve fund and take from that reserve fund to help offset the increase in cost somehow. Draw phases for inspection. So you can have up to 5 draw phases. Typically with the limited, you only have 2, but each inspection, whether it's done from the consultant or it's done from the appraiser, is going to cost you about $275 or so for inspection. Each consultant has their own inspection cost. Each appraiser has their own reinspection cost. It's going to be different and vary from lender to lender. So you want to talk to your lender about what it might be for that particular project. Title updates. For each inspection, the title has to be updated because there's money being dispersed. The title updates happen in the background with the bank. You have nothing to do with that, but because there's updates and there's costs with updates, the bank is going to charge you for those title updates. So if you have 3 inspections, you're going to have 3 title updates. And the cost is usually about $150 per title update. Again, it's dependent on your bank. You want to talk to your lender about what that might cost. Some additional costs that can be financed that are a part of renovating the house: permits, right? Whatever your permits are for that municipality to do whatever work that you want to have done to that property, they're going to cost money. You can pay them in advance and get reimbursed at settlement, and you can get those. Sometimes you get them later, or if they're required later, you can get them later and finance them as a part of those soft costs. Plans, architectural plans. If you're building an addition, you got to have an architect involved. Those plans cost money. And if you paid for those plans in advance, you can get reimbursed for those plans and finance that as a part of those soft costs. Engineering fees and the consultant fee can be reimbursed. Typically, consultants want to be paid in advance, just like an appraiser. So if you pay the consultant, you can decide later that, hey, I want to get that money back. You can finance that consultant fee in the soft cost. There's also what's called a supplemental origination fee. This is typically, I believe it's $350 still, or 1.5% the total rehab costs, up to a certain point. So all these costs added up, multiplied by 1.5%. That's charged to you. It's financed. It's basically a charge that the servicing lender's allowed to make, and they charge it on every time. So in most cases, you're going to pay that 1.5% for anybody that's trying to do a 203K loan. And that would be something you can finance. Mortgage payments finance is only for the standard loan. That's also for your something that you can finance as a part of those soft costs, only for the standard loan. So what are you doing prior to contract, right? What is the process and what you would want to do if you're interested in doing a loan product like this? So you're going to start a loan application with a lender, right? Like you normally would if you're applying for a regular loan. Submit documents to support the application, tax returns, pay stubs, W-2s, etc. Review a mortgage game plan for a 203K. So you can estimate what those costs might be, right? Based on what you're eligible for, right? We can estimate an idea of what soft costs would be, hard costs would be. Get pre-approved for the renovation loan, right? Once you're familiar with that game plan, get a pre-approval letter. Find a reliable contractor. I feel like that is one of the most important steps before you go out and start looking at properties. In my opinion, I feel like you want to find somebody that has good reviews, find somebody that's done this type of loan before, because if they're familiar with this loan process, they understand what paperwork they need to complete and how they get paid during this process. And a lot of times you don't want to work with somebody that is not liquid, meaning they don't have the ability to start work without getting all of the funds in advance. If you get this part correct, it'll make your life a lot easier when doing a renovation loan. Set up times to review properties you like with your contractor. So you're also going to be looking at properties with your realtor, but make sure your contractor tags along with you if it's something that you're serious about making an offer, so they can understand, okay, what you're working with as far as total rehab funds, right? What you're able to kind of budget for, and what that property might require, and what you might want to add to that budget. Get estimates of work you want to have done, right? It's important to get an estimate from that contractor of the work of that property you're serious about, so that you can circle back with your lender, which is the next point, and make sure it fits all the criteria, right? Everything doesn't fit perfectly like a glove. Every property has its own baggage, so to speak, right? Every property has different property taxes. Every property might not need the same work that you might think you need in general for a property. So circle back with your lender so you can kind of fine tune those numbers and make sure you're okay with that monthly payment. Make sure you're okay with those estimated costs. You're okay with that contractor game plan or estimate that they provided to you. And then when all is said and done, you can make an offer. After your offer is accepted, what are some of the steps you're going to go through? You're going to sign your mortgage disclosures, right? This is like you're officially applying for the FHA 203K loan, and you're clear and concise on all the details of the financing. You're then going to work on ordering an appraisal and a consultant if applicable, right? Get revised estimates and a mortgage game plan if necessary, right? Specific to that property. So when it's important to have an updated contractor's estimate, because if you just went in there and made an offer and you had an estimate, a general estimate on another property, it doesn't apply to this property. Or maybe something's changed. Maybe it's a property that you did look at, it's a, and you got an estimate for that particular property, but some time has gone by. You want to be as accurate as possible with this loan, because when changes occur, all the documents have to change, and that creates delays if you don't have everything accurate and matching. Um, once we have that revised game plan, you get the 203K related disclosures completed. This is like your contractor's agreement, all the documents related to the contractor having to sign and you having to sign with relation to the renovation loan itself. In most cases, you're going to have to obtain permit estimates from the municipality, right? So the contractor can take a document right to the municipality and find out what are the permits needed for in this situation. A lot of times, too, the consultant will give you an idea of what those estimates are, but to be 100% certain, you want to get the form completed by the municipality. That's right from the horse's mouth. They're going to tell you what the costs are for permits and whether you need a permit for certain types of work. Finalizing your financing, right? That's kind of working with your bank to process the necessary documents on your end, make sure we have everything matching, and then we're ready to go to settlement after we clear the loan. You're then waiting for an introduction from the servicer to continue doing work. You might have been able to do the first phase of work if you got some type of disbursement at settlement, but you really don't want to continue working when money runs out until you get that introduction from the servicer and they give you steps to follow instructions from there. Common pitfalls I see with this loan is underestimating costs. That's super important. To me, I feel like you always want to overestimate to be safe. You never want to be in a position where you get an estimate and maybe you're on the edge of qualifying, or you're concerned about your mortgage payment. Those costs, right? If they're underestimated, they can change your monthly payment, change your qualifications. So it's good to overestimate in this kind of loan type, or any loan type for that matter. Hiring the right contractor, I stressed that before. It's super important to hire the right contractor. Talk to people that have worked with contractors before. I always like looking at reviews, Google search somebody, get some information about them from friends, family. Use people that have, used a contractor that somebody like and trust has used before. I feel like that's super important. Understanding loan terms and costs. If you're unclear about something, you want to ask questions, right? You don't get into something that you don't understand, especially when it comes to terms and costs. And I know loan officers aren't always the best at explaining things, but it's important because this is your big decision, right? That you understand it. And if you don't, ask a lot of questions, because I feel like these topics, especially these types of loans, can be complicated at times. So ask more questions and feel comfortable about that. Enough time to complete the process. If there's a lot of changes and a lot of people involved, usually things can take a little bit longer to complete. And in my experience, a lot of times I feel like professionals, realtors, buyers, they might not understand that because of this many moving parts involved with this type of loan, because there's this many moving parts, that you can close in the same time as a traditional loan. And that's not the case. And typically I would always estimate 45 to 60 days. And even then, that might not be enough. It's all relative to everybody communicating in a timely fashion and not having a ton of changes. If there's a big project, that could take longer. So just keep that in mind. Multiple changes can happen, right? I've seen situations where contractors, you can't get a hold of them. Then you have to find a new contractor, and that estimate is different. So it all comes down to, being patient and understand that if there's changes, it can cause delay. And because there's a lot of people working on this type of loan, it can cause a delay. Understand the post-closing process, right? I feel like the big thing about this type of loan is that once the loan closes, you're going to get that money. But I feel like if you don't understand that there could be a time in which it's going to take from our company or one lender to sell it to another lender who's your servicer at that point, it might not happen in a week's time or 2 weeks' time. It could take 3 weeks, sometimes even 4 weeks, depending on how complicated the loan is. You just have to have patience and understand when you're going to get paid. And as soon as it's set up with that servicing lender, then you can continue the work on the property. Lack of communication, like I said, if you have trouble getting a hold of your loan officer, getting a hold of the consultant, the appraiser, the contractor, it's just a recipe for disaster. Make sure that you're communicating with all the individuals in the process. And more importantly, make sure that you're in communication with your contractor and your lender. Inaccurate documentation. When I said, like, a lot of times, the biggest pitfall in general for mortgages is having inaccurate documents or documents that don't support what we need to clear conditions, right? Having all the pages to a bank statement, having all the pages to the contractor's estimate, making sure that the contractor's clear on putting together the estimate the way that it's needed for the bank to be able to do this type of loan. If there's inaccurate documentation, let's say the estimate that we have is going to change, that means that the appraisal report has to change, right? That means that the consultant's report has to change. So inaccurate documentation leads to frustration. It leads to delays. So the more accurate we can be with documentation, the better. Understanding the 203K, um, understanding that there's higher costs involved with this type of loan versus a standard FHA. A standard FHA loan has typically lower interest rates and lower costs, right? Not to mention that if you were able to do the work on your own, it might be lower cost to you as well. But this is a very good tool, a very good loan if you're trying to get everything umbrellaed in one loan payment and done all at once. So you're able to buy the property in its current condition and then have work done to it immediately. And then by the time you move in, the house is the way you want it. In conclusion, I feel like the 203K is a powerful financing tool to help you renovate your dream home. To ensure a smooth process, you want to work with an experienced 203K specialist who can guide you through the process and help you avoid common pitfalls. If you're interested in a 203K loan, you can reach out and we will gladly walk you through the process. Here's all my contact information. If you want to get the ball rolling, I'm going to put the link to the application for any loan, whether you're purchasing using a conventional, a USDA loan, an FHA loan, or this loan, 203K loan. I'm going to put that link in the description. You can also call that number, 856-395-9390, or email my loan team, and somebody will reach out to you as soon as possible to help you on your way. If you like this video, hit the thumbs up. So subscribe to our YouTube channel or my YouTube channel. And if you want to get updated whenever we put out videos, hit that bell sign. That's going to give you some notifications. Thank you for watching my video, and I look forward to helping you in the future.